on the boards. And
I guess we'll kick it off. Another episode, Indie Investor Speakeasy. Finally got somebody on here.
we got somebody to actually come
We
on.
got somebody smart on here besides us.
Well, has it just been you guys?
Yeah, it's just been us.
But am I your first guest?
Yeah.
First guest, dude. Cheers to that. Honored. Yeah. Cheers to that. Join us here. Took us 6 episodes before somebody was willing to come on. We had to up our production quality a little bit. We got the TV behind us. Yeah, but yeah. Thanks for having me on.
On.
Hi there.
I'll probably the stag and that.
Behind the
which is very good.
Yeah,
it is very good.
If anybody hasn't heard of that one, preservation, super solid. Well, Jared, I think you probably need no introduction at this point, but are you willing to give a little bit of your background?
Yeah, I'll give a short little background. So first off, thanks for having me on, and this is exciting. First guest. So
Yeah.
I grew up around here in Indiana, and I'll kind of go the full circle of how I got into lending. But I was a baseball player, just kind of like Brooks was over here in college, and left college and got into the landscape industry, ironically. So went from there to retail, and then there for the end of lending. So I've been in lending. This is actually a little over 10 years that I've been in the lending space, and really started in the retail refinance primary residence stuff. And then kind of by accident, through some connections, really started diving into the investor world. And, over the last 5 or 6 years, here we are. It's been, we've seen a lot of ups and downs in the market and with investors, but we've kind of been tried and true and, really developed our product line. And so over the last, 2 years, really, the goal for us was to break off from the big retail lenders that we've been working for and start what we have now with Mamba Mortgage, kind of an independent brokerage, being able to kind of be a one-stop shop with all lending, retail, residential, investor, primary residence stuff. So we've got a little bit of everything now. And so
that's awesome. Well, this is going to be the first episode where we've talked a little bit more specifically about lending. Obviously, you can't talk about real estate without lending a little bit, but this is going to be the first time that we're kind of dug deep into it. So are you willing to give kind of a little bit of summary? Like, the last couple of years have been different, for sure. Very different than what we're facing today. Are you willing to talk a little bit about kind of what was happening over the last couple of years from your perspective?
For sure. Well, COVID had a lot to do with the last couple of years. We're kind of out of that COVID stage, but we're really recovering from a lending side of it. Honestly, COVID was the best thing that ever happened to us on the lending side. Rates plummeted overnight with that, and so we got really busy. And so what's changed really since then is a couple things. One, we went from a really conventional heavy market to now. You fast forward. Almost 3 years now, or more than 3 years, the rates we're at an all-time high going into the end of 2023. Everything switched at least on the investor side, to more of the DSCR market. Conventional rates were atrocious. And so there's just been an adjustment, I guess, if you will, in rates and where people are moving their business to in terms of what products, fit their needs.
Yeah. I think that makes a lot of sense. I think we saw over the last several years, obviously people were buying as much as they possibly could. They were doing non-contingent type of offers just to get something. I think what made up a lot of the lending market over the last several years probably was refinances too. And that probably dried up as rates have increased. Is that generally right? Or like, what are you seeing there?
Well, so, our business is so different than kind of the holistic market of lending. So to answer your question, yes, refinances have dried up. We've stayed pretty busy with refinances, mainly because, our clientele is predominantly investors. Our refinances are different though. Our refinances are from clients who have bought a distressed property. They've either bought it cash and now they're trying to recoup their cash, or they bought in with a hard money loan. They're high interest rates. So, at the time, last year, an 8.5% rate sounded pretty good to them. Coming out of a hard money loan. So we've actually stayed pretty busy with the refinance side of things, but it's been different than what your average loan officer is dealing with right now.
More like the Burr type investor.
Correct.
Gotcha. Yep. Somebody who goes out there, forces the appreciation versus somebody who's just kind of waiting for it to happen to themselves.
And are you doing the hard money this as well? Other stuff, your original?
Some yes. I would say it's probably 50-50. Some people are coming from somewhere else, some are coming from in-house. And I think that's one thing that makes us very unique is that we try to be as much of a one-stop shop, where we can do the hard money, we can do the DSCR refinances or the conventional refinances or turnkey purchases.
Would it be okay if we took a quarter step there?
Yeah.
Like you're saying a lot of terms. We obviously here in the room understand, but people watching might kind of struggle with a little bit. So are you willing to talk a little bit about the different types of loan products? Traditional FHA type products. Then you've got DSCR, you've got hard money. Like you're willing to bridge. You're kind of
our world is all acronyms, right? And if you don't understand the acronyms, it's hard to understand what we're going on. So, let's start with the conventional side first. Conventional FHA, even like VA loans, things like that are more your traditional style financing. The big difference there is we care about you as the borrower in terms of income, credit. Do you have the cash to buy the property? So we're just taking a little bit more deeper dive on you as the borrower. Those are they're I don't know. Some people say they're easier loans to do. Other people think they're harder loans to do because there's more documentation. They're just less risky loans. Let's put it that way. They're backed by the government, right? Fannie Freddie is they're a liquid GSE, if you will, a government service entity. And then FHA and VA are also backing those loans. So, they've got guidelines that we have to follow. The other side of that is, where they're more investor specific, hard money, DSCR, which stands for debt service coverage ratio. These types of deals, we don't really care if you have a job. The income that you bring in from, personally, we don't look at or validate. It's more so, does the property cash flow? Are you getting more rent per month than your total mortgage payment?
Entity as the actual business.
Yeah, they're business purpose only loans is what they are. They're not individual loans. So those are really the two big differences between those sides. Is one is a business loan and the other is a personal loan.
Gotcha. It makes total sense. And hard money, are you willing to talk a little bit about what that is?
Hard money is so it's an interesting animal, right? It's people get scared of hard money loans because one, they don't understand 100% of how they work. Because we are a culture in the lending side that all we look at and care about are two things: rates and cost, right? Is the rate high? Is the cost high? I don't want to do it. But hard money loans give you the opportunity to leverage your cash to buy a distressed property, way undervalued, be able to finance the rehab in it and force appreciation, like you mentioned earlier. So, maybe you're buying a property for $50,000. It only needs $50,000 worth of work, but it's going to be worth $200,000 when it's all said and done. Yeah. Right. And if we find that deal, let's jump on that one. Right.
I'd love to find one of those. Yeah.
How do you qualify somebody for that? Is that different?
Yeah. The qualification really on a hard money loan. And it's hard for me to pinpoint it because, again, we have multiple different avenues that we can take and they're all a little bit different. But for the most part, it's just credit score and do you have the cash, right, to buy the property? Some of them require a small down payment on at least the purchase side. Others, we can go up to 100% financing as long as it fits inside of kind of a ratio box. We always work backwards. Okay, so when I look at a deal, somebody says, "Hey, Jared, I've got a property, I'm probably going to buy it for $100K. It needs $50K worth of work and it's going to be worth $200 when it's all said and done." I start with that $200 and work backwards. So usually 75% is the max we can lend on of your after repair value, which gives us in that scenario, $150,000. And so then it just depends on what lender we're using, right? If we can go 100% finance, perfect. We can lend all of the $150,000, including the rehab budget. Others you might have to bring a little bit more down, but yeah, for the most part, we need those three numbers and then kind of figure out the ratios that the lender wants to work with there.
You say cash, you mean like just the cash for the down payment?
Correct.
Okay.
Down payment and closing costs.
Yeah.
Mhm.
Gotcha. Does experience matter at all?
Yeah and no. Some do. Some of our like our 100% financing option, no experience required. You just have to have cash. And it's not a lot, but you do have to have at least. You want to make sure you got some skin in the game. Um, some of our other products, it is experience based. So the more experience you have, the better terms you're going to get on it. So yeah, there is some experience in there. But as long as you've got the cash and credit score, we'll find something for you.
Yeah. So
yeah.
How much experience are you looking for when you're looking for that side of it?
Yeah. So if we're using a product that is experience based, your kind of top tier is going to be anything 5+.
Okay.
If you've got 5 deals plus over the last 24 to 36 months, you're golden.
if you don't have it, Brooks,
if you don't have experience, though, all it does is it just increases your down payment, your leverage, or decreases, I should say, the leverage that you're going to be able to use. So
still find something.
yeah.
This question we had was some of the current trends that you're seeing in the lending field right now, what you're seeing from other investors or hearing from other investors.
We're busy right now. Rates are going down.
Majority of your loans are probably
Yeah. We've been seeing a lot of turnkey deals come through, which is ironic. So with rates going down, the market has brought back. I mean, and it hasn't gone down a lot. We're talking. I mean, I guess it has gone down quite a bit because we were, it's at least a half a point, if not more, than what we were at even at year end. So, even today, as of what is today, the 11th of something like that, 12th of January. I saw a rate today at 7.5 for a DSCR loan, which I haven't seen anything in the 7s in probably 3 months. So we've seen a pretty drastic decrease. What that does is it pushes a lot of people back to conventional because conventional rates are a little bit better.
Yeah.
So there's just been. And again, it kind of goes back to us being a multifaceted lender. Like every deal is a little bit different. And so, sometimes the DSCR is a little bit better for that deal. Maybe a conventional loan is a little bit better. So
help steer somebody.
Yeah, we'll at least present the options to them. Yeah.
That makes a lot of sense. I mean, you talked a little bit about interest rates that you're seeing today. The majority of the people you're working with that are doing the longer term loan, the hard one, kind of going the DSCR route today. That generally, if you were explaining what terms somebody might see today, obviously rates change by the day. But what are the other terms that people need to be aware of?
Yeah, we're also looking at how long the loan is, right? What's the amortization schedule of that? 30 years is what all of our long-term stuff is, which again is kind of unique in the DSCR space. So everything is a 30-year deal. So it gives you a little bit better cash flow. The other terms you need to pay attention to on these deals, on DSCR specifically, is prepayment penalties. Nobody wants a prepayment penalty. And one of the reasons we've done a lot of DSCR loans, ironically, is because there are prepayment penalties. So, and I'll explain a little bit more why. But usually the prepayment penalty term is going to be somewhere between 1 year and 5 years. Okay. So if you sell or refinance that property during the prepayment penalty time, you're going to have to pay a penalty. Usually a 1% to 3% penalty of whatever unpaid balance you have. Now, why prepayment penalties are actually a good thing for DSCR loans in this market? Conventional loans, and what really all the lenders know, you're going to refinance at some point in the next year or two because rates are going to drop, right? And so conventional loans not having prepayment penalties, they're not protected, right? And so what they're doing is they're charging a lot in discount points. And discount points are basically a buy down or prepaid interest just to get the interest rate. So I've seen 4, 5, 6 points just to get the highest rate available, right? Because they know they're like, hey, we'll do this deal for you, but we want our interest. Whereas a DSCR loan has the prepayment penalties on it. And so up front, they won't charge any discount points to get the rate. And so the rates may be the same or if not a little bit better on a DSCR loan. So for the past, 9 months, almost exclusively all of our deals for investors have been DSCR because up front, the costs are significantly better. So prepayment penalties, nobody likes them, but they're actually a good thing right now in this market for DSCR loans.
It makes a lot of sense. You're planning to hold the property for a deep extension. Like if you're in year 1, 2 years, probably not.
Right.
If you're thinking 5 years.
Yeah, and this may be like way down a rabbit hole here, but not to play on word medicine bourbon we were talking about earlier. But the prepayment penalties have gotten really low. So like we're doing a lot of 1-year prepayment penalties with only a 1% penalty versus what we were doing early last year was 5% penalties with a 5, and it's a tier. So it's 5, 4, 3, 2, 1. Meaning year 1, it's 5%, then 4% the next year, so on and so forth. So we've seen the pricing get better at the 1 year because these lenders want to entice people to still do loans with them and not push them away with the higher prepayment penalties.
That makes sense.
Yeah.
With that in mind, talk a little bit about qualification criteria. You want to tell a little bit about how the changes in the economy impact your ability to give out loans because somebody has to buy that loan again.
Sure.
What does that look like?
Yeah. So lenders, you mentioned the Burr method earlier, right?
Yeah.
Lenders do the Burr method too, right? They've got these massive warehouse lines of credit. Okay. And so if you go to, I don't know, just, you go get a mortgage, and you get $100,000 mortgage, that lender's going to sell that mortgage, right? But why are they selling it? Well, they're lending money off of their line of credit. So they're not just, they don't have billions of dollars of cash sitting around. They have these lines of credit. So when they lend you $100,000, it takes up room on their line of credit. And now they've got to have to pay interest on it, right? So when they sell that, they're selling it to get it off their line to keep them liquid so they can go and do it again. What happened in COVID years was all the investors that were buying these loans stopped buying it. Well, all these lenders were still lending and they dried up their lines of credit, right? Because they weren't buying them off the line. They didn't have any more liquidity to lend. I think what we've seen is people get a lot smarter with their lending. So the criteria has gotten a little bit better. The products have actually gotten better and they've brought more people on to create more liquidity. So that's probably been the biggest change that I've seen in the lending world from a qualification standpoint, at least on the back end of loans, is that we've seen a lot more products come out, probably for the better, and a lot more unique products that we didn't see prior to COVID.
Every time I see you, you're like, well,
it's honestly the hardest thing for me to keep up with because not only do we get new products all the time, they're changing and making them better, but all the products change guidelines too. So, that's the hardest part of our job is just reading guidelines.
Well, we're kind of coming in with basically the beginning of the new year, new you situation. A lot of people are going to try and get their financial situation right here in 2024. What advice do you have for people who are looking to get started in real estate investing? You can speak about real estate investing, or you can go kind of into the lending to prepare for whatever's coming. They do begin investing here in real estate.
I think at least early on, buy now, because this market's about to get crazy, very competitive. I don't think we'll see it kind of what we saw in 2020, 2021 on the buyer side, but we're definitely going to go back into a really high seller market. And so I think first and foremost, if you have the ability to buy now, do it. And then you can refinance, later down the road. But if you decide to wait to see, where the rates are going to go, that just brings more people to the market. It drives the house values up. So, you may get a lower rate, but it's not going to impact your payment that much where, if you wait and the house values go up, those are dollars out of your pocket right away instead of maybe over the long haul. So I think that's probably the biggest advice I have is get in the game.
Get in the game before it's crazy
Right.
again. Yeah. I hope you're right. I hope it does get crazy again.
I hope so too. Yeah.
Pretty good for those who are working in this.
Yeah. And just in the first few weeks here, if the trend continues, like I said, we've seen rates drop pretty drastically, and it's an election year too, so we'll see what happens.
We talked to the last one, like we're starting to see a little some of our stuff that's been for a little longer than we would like. Nothing new. And on top, I guess to build on what you said, for advice for newbies, if they are buying their first investment property, how should they get ready? Because more than likely they're going to need to come to somebody like you for a loan. How should they get ready on the financial aspect on the personal side to be ready to get qualified, something like that? Or should they get qualified first or find the
Man, it's a good question. I've seen it happen both ways, but if it was in my perfect world, they'd come to me first and get qualified, so then it's not as hectic on the back end. So if we can get you qualified up front, which the biggest things, you want to have your assets right. Make sure it's a cash game, right? You want to have as much cash liquid as possible. And 2 is credit. Making sure your credit score is good. That you're not missing payments, you're not going out and taking a lot of debt right before, which we don't really care about the debt on the investor side, but the debt does impact the credit score. So those are the 2 biggest things that we look at up front from a qualification standpoint, is just the credit and assets. Everything else is property specific. So if you're somebody that's sitting on a lot of cash, you've got really great credit, you might be that person that can go find a property first and then come to me and be like, Jared, we're under contract. Let's figure the financing out now. But if you have questions and you're like, I don't know what I qualify for, or I don't even know what products are out there, like what does a payment look like on something like this? That's when you would want to give us a call first.
DSCR.
Yeah. And let's say pick out there. A lot of agents, which most people as they're starting out should use an agent in their initial transaction.
Yeah.
A lot of agents are going to give you the time of day to have some type of relationship with the lender, because you're qualified to go buy a house. Why would an agent go and spend the time to write an offer, walk them houses,
100%.
actually able to buy it? So I definitely recommend.
That pre-approval letter that we give out is it's powerful. Not only for the agent that you're working with to go show you houses, but when you put an offer in, having somebody reputable that's on that piece of paper that says, hey, they're qualified. Yeah. The list agent and the buyers or the sellers, that gives you just more ammo to get your offer accepted.
And coming from guys who have been on the other side of that, that's going to play into it for sure.
Yep.
No, we got somebody to go rather
than like that credibility packet that the agent walking with what that makes a ton of resources cool that you think people should be thinking about just
in terms of just anything.
They're going to do their own research without
to start. Honestly, I mean, the biggest thing I always tell people is you got to create your team, right? Your team is your resources. We live in an information overload world. And so, I mean, you could go to things like Bigger Pockets. There's forums on Bigger Pockets. We get on Bigger Pockets as a lender to draw leads, right? There's probably 20 different new conversations on the forums per minute that happen on there, right? I mean, it's overwhelming. You can't keep up. There's just too much information, and some of the information on there, honestly, is inaccurate. And sometimes it's accurate, but doesn't apply necessarily to 100% what you qualify for or what you're looking to do. So, get your team, use them as a resource, and build your kind of buy box, right? Like, what are you looking to get done? And then build your team around that.
I think that's a really good call out, to build your buy box. A lot of people think that they'll know a deal when they see it.
Yeah.
You don't know a deal when you see it. There the weird opportunity out there. You understand, I'm going to buy this price and fundamentally understand what your mortgage looks. You'll understand what Jared's willing to lend on and not buy box in your particular situations. You have to really
and I'll back up a little bit and I say find your buy box and then expand it a little bit right now, right? Because the deals are hard to find. The hardest part in this whole process isn't the lending; it's the finding a property that works. And so, 3 or 4 years ago, finding a property was easy. Everybody, there were more properties than people know what to do with. Right now, there's more investors than properties. And so, if you had this box that you said, hey, I need to only look in this area, at this price point, maybe expand it a little bit. Otherwise, you might get pigeonholed into, an area or a price point that's just not applicable anymore.
And just to do a little bit of research on your own before you start calling a Jared, going through the whole process. And why did you think this was going to work? I mean, it's just a waste of time. A little bit of research there. Maybe call your agent, run it by them, and see if it actually is a deal that's going to work, or even
a question and not the next word of the day. We're getting to it, but it's realistically, what is the best way if people want to reach out to you, reach out to your team, for them to come in, potentially get qualified and build that first member of their team within the finance?
Absolutely. First, probably the easiest way right now is either text or email. We're building a team, so we're trying to make it from a capacity standpoint where we can handle as many people as possible. But you can text or email me. 317-931-9759 is my cell. And then Jared, Jared, at mambamortgage.net is the email.
Fantastic. Perhaps you want to take it home with an important question?
Most important question of the day, and I haven't gotten to all the picks here, but we just had a pretty good haul come home. I'm not sure if you had all of them yet. Your top 3 bourbons.
Top 3.
I don't want to narrow it down to one because that's hard.
That is a tough one.
So
all whiskeys. You rise to a little bit.
And so, all right. So top 3. My number one favorite is always just a go-to is Weller 107. Weller Cucho. It's just good. And it's it's one that you can find. Obviously, there's some unicorns out there, right? Now I just had my all-time unicorn. I was able to try it earlier this summer. I guess last summer was William LaRue Weller. And it was 2019 batch. It was honestly one that I stared at for about 5 minutes because I was like, I don't know if I want to actually drink this. Like so it was very, very good. Oh, it's delicious. Very delicious. And then probably my last one's another just easy to find good one is just Russell's Reserve. It's just
what we drank last one.
Yeah.
I think Russell's
it's great.
Closest.
Mm-hmm.
Can still find.
Yeah. Now I'm not a huge Eagle Rare fan, and I don't know why, but I like it. But I think
cutting with
that's like one of my time.
Yeah. But I love Elijah Craig Barrel Proof. I like the high proof stuff. Elijah Craig is great.
Well, appreciate you being here. I'm sure people are going to be reaching out. They got a lot out of this. Everybody reach out to Jared if you have any needs here in the Indianapolis or actually what markets do you serve?
That's actually a good question. Most people think we're just in Indianapolis. I mean, obviously we're local to Indianapolis, and I don't know if anybody saw the report that just came out. The Indy's, one of the top 3 markets in the country going into 2024. So it's pretty sweet. Now, conventionally, we can only lend here in Indiana, but on the DSCR side, it's nationally. We do it anywhere. There's a couple states we can't, but for the most part, we're in all states.
Fantastic. Lending me country, but Mamba Mortgage.
My Maryland friends, hit up Jared.
Perfect. All right. Well, thank you for joining us.
Thank you.
I'm sure we'll have you back.
Appreciate it.